Welcome, everyone. Thank you for attending today's session. We're talking about the one big beautiful bill and what it means for employers. If you're not here for that, well, got a lot of registrants and hopefully everyone can get in. So if you're not here for that, get out. But if you're here for that, we've got you covered for the next hour. Before I introduce my wonderful colleagues, let me get through a couple of housekeeping measures. First of all, down near the bottom of your screen, depending on how you have your Zoom window oriented, you might see a closed captioning button, or you might have to click on More to get to the closed captioning feature, but it is available for anyone who needs that. This session, I did remember to hit record, is being recorded on YouTube. If you're watching on YouTube, hello. Don't forget to hit the like button, subscribe, especially if you get through this whole video. I'll do the reminder at the end. Like, if you really liked it, click the like button, subscribe, comment. Uh, but don't ask for legal advice. This presentation is for informational purposes only, does not constitute legal advice or create an attorney-client relationship in any way whatsoever. We trust that some of you joining in today are our clients. Not for the next hour, you're not. Nothing here is legal advice. We assume that all of your questions, no matter how good, bad, or indifferent, are hypothetical and you're asking them for a friend. We'll try to get to some of your questions in the chat. I'm going to warm you guys up. Let's see if this chat's working. If you could take a tax deduction for something totally absurd, what would it be? You see my answer. So let's see how the chat's working. My dog. I love it. Super, super, super. All right. I'm multitasking here as I try and let people in from the waiting room. We had a lot of registrants for this one, over 1,100 registrants. I'm going to make sure people get in an orderly fashion. And while I do that, I want to let my guests introduce themselves. I'm looking at the Brady Bunch square with Jewell to my immediate left. Jewell, you want to introduce yourself? Tell everyone what's going on?
Yes, yes. Thank you, Eric, and thank you everyone for joining our group here. My name is Jewell Lim Esposito. I've practiced now for 30 plus years. I was a tax attorney for a long time, tax controversy, and then in later years I specialized in employee benefits, executive compensation, retirement and health plans. Happy to be here with my partners and colleagues. Thank you.
Jewell, thanks for being here. And as I continue around the square, Liz, you're up. How you doing, Liz? Good to see you.
Hi, Elizabeth Delnegro. I've been practicing for about 10 years and I primarily focus on international tax and I handle some corporate stuff as well. So excited to be here.
Thanks for being here, Liz. And then last but not least, with the thickest specs, which make him the biggest nerd, Greg McKenzie. Good to see you, Greg.
Definitely. Thanks, Eric. Great to be here. I'm a tax lawyer. I've been practicing for about 30 something years. Focus most of my practice on federal income tax. I do a fair amount of cross-border work as well. Look forward to this opportunity to speak.
Beautiful. Thanks for being here. I appreciate it. So, folks, again, you guys, the chat is definitely working. If you have questions along the way, ask them, but we have a pretty loaded session. Let's get started. I'm going to frame it with a little background on the bill. On July 4th, the usual fireworks and fanfare, President Trump signed the One Big Beautiful Bill, officially titled An Act to Provide for Reconciliation into Law. It's nearly 900 pages of dense tax reform. And while it made headlines for cutting rates and expanding credits, employers got handed a lot of new obligations along the way, as did employees potentially. But we're here to break it down for the employers. So let us know in the chat what worries you most. Is it reporting on OT and tips, Trump accounts, ACA pre-verification, or something else? Let us know in the chat. We'll try and address it. Will this recording be available afterwards? Yes, I'll post it on the YouTube channel. All right, so let's get started with some level setting questions. And Greg, what is like it's 900 pages, but what is the OBBB, the One Big Beautiful Bill, and why is it considered the biggest tax overhaul since 2017?
Well, it is mammoth in size, and it affects many of the provisions in the Internal Revenue Code affecting individuals, employers, employees, businesses, international taxpayers, um, the energy sector. So it has a very wide reach in terms of the people it affects and the provisions of the Internal Revenue Code that it affects. And it's really kind of Trump 2.0. In 2017, under his first administration, uh, uh, the 2017 Tax Jobs Act was um, enacted, and it provided, again, it was also a very large tax bill. This bill works off the original 2017 tax bill and extends either permanently or temporarily many of the provisions under the 2017 Act, such as permanently extending the top individual tax rate to 37%, extending permanently an estate tax exemption amount of $15 million, uh, increasing the SALT state and local tax deduction to $40,000 from $10,000, but that only stays in effect for years ending before 2028. So, there's a lot in this bill. There are additional new provisions, some of which we'll discuss today, but there's a lot to read.
Kristen Toner asks, did you guys run it through ChatGPT to sum it up, or was it just me and most of Congress? I can assure you, Kristen, and the rest of you, that Greg, Liz, they prepared a white paper. I know they read through this thing. So I will share a link to the white paper. Uh, I might have cheated a little bit with some AI, but I'm guessing Jewell didn't. I'll bet you read it too. So, Liz, what parts of the OBBB are most relevant for employers? What do you think?
Yeah, I think there's probably about 7 key areas that are going to impact employers the most. The first is the paid family and medical leave credit. That's now permanent, and it's going to have some changes associated with it under Section 45S. Obviously, the no federal income tax on tips and overtime under Sections 224 and 225 are going to be a pretty big impact for employers. I see in the chat a lot of people are concerned with the overtime, how you're supposed to calculate that, and how you're supposed to change your HRIS systems on that. Some other things are going to be the health savings accounts and telehealth options. Dependent care flex spending accounts have changed a little bit. There's some new educational assistance / student loan repayment options that have made some changes. And then the Trump accounts and fringe benefit reporting.
And Jewell, what are the highlights of some of the employee benefits changes that we got from this new law? Excuse me. It's not a bill anymore. It's law.
Yes, yes. So a lot of times employers will ask of us, how is it that we can give more perks or more money to employees without incurring income tax to the employee and payroll tax to the employer and then the employee's share of it? And this particular law now makes permanent the ability, a lot of companies say, what can I give my employees for quote unquote free? And now for sure, and it'll be indexed higher and higher for future years, that employers can give $5,250 to their employees for payment of student loans, and that 5,250 annually, and then again, index for inflation, will be income tax free to the individual and no payroll taxes will be paid. That is a nice perk to extend to employees. When an employer couples that with the ability to, for example, match what an employee pays towards a student loan by providing a match into a 401k, then that's another way that an employer can give to an employee an amount of money that is free of income tax to the employee and free of payroll taxes to employer-employee. So it's taking parts of this law and fashioning what is essentially an overall education or student loan program. And it should help with recruiting and retention if the employer wishes to give these types of perks. Another way that an employer can give a perk to an employee is to go ahead and take the advantage of the benefit of the Trump account that's being set up. It's essentially what I would call almost an infant IRA, an infant individual retirement account, where if an employer wants to give this money to their employee for the benefit of their child, the employer can give $2,500 annual. Again, I'll call it free money. I mean, it costs the employer. They get a deduction for giving it, but there's no payroll tax associated with that $2,500 that they'll give to the employee for the account. And then the employees can supplement that account by putting in after-tax dollars. But that is a great way for the employer to give $2,500 to the employee, get $1,000 from the U.S. government, and then perhaps get even more money from like charitable organizations or states. So this is a great planning opportunity for an employer to think through how they can give more perks to their employees without triggering income tax or payroll tax.
Thank you. So I would expect, and a lot of our audience should expect, a lot of questions from employees. Like, how does this bill affect me? How does this law affect me? And I suspect that one of the questions, Greg, that's going to come up from employees before we tell them, go to your tax advisor, they'll give you the answer, is what's the difference between a deduction and a credit from an employee's perspective? So
Right.
what is the
So,
difference?
yeah, for an employee or any taxpayer, deduction is worth the amount of the expense multiplied by the effective tax rate. So if you have $100 of expense that's deductible and the tax rate's 30%, it's worth $30 to you. Whereas a credit is a dollar for dollar reduction of your tax bill. So if you have the same $100 in cost and it qualifies as a credit, that's worth $100 to an employee.
All right, folks, now we're going to start to get into the nitty gritty. We did a little base level setting there. This is going to be where Greg is going to cook for a couple of questions. And keep your questions coming in the chat. I saw Liz was answering a few in the chat. We'll get to as many as we can, but no tax on tips, right? That from an employment lawyer standpoint, I see that, and like that's as far into the one big beautiful bill as I get as an employment lawyer. Because, okay, tips, like that's an employment thing. That's an overtime thing. That's a Fair Labor Standards Act thing. But it sounds catchy, no tax on tips. But are employers really off the hook when it comes to no tax on tips?
No, employers are not off the hook, and employees are not off the hook. It's the tax benefit is a tax deduction that the employee has to complete on his or her individual tax return. Right now, as it stands, employers would continue to or should continue to withhold and report based on total compensation paid, including tips. There are limits in terms of how much of the deduction can be taken if the employee has additional income at $150,000 of adjusted gross income. The $25,000 of tip maximum amount begins to be phased down. So, unlike other withholding issues, in this case, I don't foresee. So one issue is whether or not, there's going to be any new guidance that allows an employer to withhold something less than it otherwise would have based on tips or overtime pay. And I'm not sure how that would really work because a lot of the computation happens on the individual 1040. But the IRS is required to provide some transition guidance for 2025. The W-2 will very likely have to be revised to allow for the correct reporting of both qualified tips and qualified overtime compensation. It's not clear whether the revised and updated W-2 will be ready by January 31 of 2026, which is when they would be due, or I think actually on February 2nd is the due date because that's the first business day. So, it will be important for employers to look for updates from the IRS providing guidance on how the reporting and withholding obligations have to be accounted for.
So in terms of what exactly do employers need to report on the W-2 for qualified tips and overtime, and when are we're waiting for the IRS to key us in?
Yeah, right. Right now, the current version of W-2 would not really accommodate that type of information. It does have several boxes that talk about tips, but it's not, you wouldn't know. What you ultimately have to be able to do is understand the total amount of tips that the employee receives. And right now, that's not possible in the current version. So what I would foresee is that there will be several new boxes on the W-2 to allow an employer to report the actual tip amount, and not as part of the compensation that's reflected in other of the boxes. And one of the other pieces of this is that by October 2nd of this year, the IRS has to publish a list of occupations that, as of December 31, 2024, customarily and regularly receive tips. So that information will be coming out from the IRS by October 2nd. And then as part of the reporting, an employer will have to indicate what the occupation is. And I think for most purposes, that would be essentially the business of the employer.
So that segs into the next question I have for you, Greg. What are qualified tips under Section 224, and how will the Treasury's occupation list impact reporting?
So qualified tips can be cash tips, charged tips, and tip sharing. They can't be negotiated. It's at the absolute discretion of the payor whether or not to tip. So, if you have a restaurant where there's a large dining party and they add on a gratuity, that would not qualify. That tip would not qualify as a tip that would be deductible on an employee's tax return.
I want to make a clear point for the audience. So when a group goes into a restaurant and leaves a tip on a receipt, whether it's a cash tip or a credit card tip, that tip belongs to the employee. This is where I get to chime in with some Employment Fair Labor Standards Act stuff. I saw a post recently on LinkedIn about, maybe it was based off of a Reddit post where the restaurant was saying, well, no, that's ours. That's ours, the tip. No, it's not. The employee gets any tip that is left, whether it's a cash tip or a credit card tip. Now, there may be tip pooling that goes involved in the workplace. We're not going to focus on that here because this is more about the OBBB, but I just want to make that point clear.
Right.
Greg, for qualified overtime compensation under Section 225, what counts and what doesn't?
Well, so again, with overtime comp, there is going back for a second to the employee's individual tax return, there's a limit of $12,500 that can be deducted in terms of overtime compensation reported to the employee. And this is true both with respect to tips and overtime. If the employee is a individual that's married, he has to or she has to file a joint tax return in order to claim the deduction for either qualified tips or qualified overtime. I think in terms of what is qualified overtime, it's the overtime that's required under Section 7 of the Fair Labor and Standards Act.
Okay. And then is the IRS, well, I think we know the answer to this, but what level of chaos should we expect at the IRS? And how prepared do we think they actually are for this?
So, I mean, there may well be some chaos. I don't know how much, but it's really there's a perfect storm right now between significant workforce reduction within the IRS. I think like 25% of the workforce has been reduced. You have a very complicated new tax law, and which requires uh, pretty immediate guidance from the IRS in terms of how the law will be implemented. So under those circumstances, I think it's going to be um, unsettled at least through the end of the year. It's important to continue to follow any developments. For example, the IRS issued, I think, on July 14th, a fact sheet which talks about some of these provisions relating to tips and overtime compensation. So, my recommendation would be to continue to keep on the lookout for interim guidance that will be coming from the IRS, hopefully sooner rather than later.
You said July 14th from the IRS was a fact sheet.
July 14th. Yep.
If
Yeah, it's
someone if one of you lovely people wants to drop that in the chat while we're talking, that would be awesome, and I will incorporate that into the description when I post this on YouTube. So we have beautiful Shayna. Thank you. We speak your name. All right.
actually, Eric, one last point.
Sure.
It's worth noting that both for overtime and tips, these are only temporary provisions. So if nothing else happens, 2028 will be the last year that tips or overtime can be deducted by an employee.
Okay.
When does it start, Greg?
January 1, 2025.
All right.
So it's retroactive.
So,
So,
Eric,
oh, go ahead, Liz. Jewel, yeah, go ahead. Yeah.
a point that I want to underscore here is so much of this law means that an individual, as an individual, not just as an employee, has to watch what's happening with these laws and almost self-advocate if this is what's needed, at their employer level for any of these things that we're talking about. The individual can like ensure that its employer is doing what it has to do for overtime, for for tips, for any of these education benefits, for the Trump accounts. I mean, employers will do what they have to do, and a number of the provisions in the law, an employer doesn't have to do it. So, but if an individual or a whole workforce might want it, then that individual or that workforce has to push for it. So a lot of this is self-advocacy and for the individual to understand the overall law so that they know how the individual can benefit with some of these provisions.
Thank you.
So I think one point also on the tips and overtime, I believe that it's retroactive to the beginning of 2025, but the employer requirements to identify and separate and do all of that I don't believe is applicable until 2026.
Yeah, I mean, I think that again, 2025 is a transition period, and the IRS is supposed to provide interim guidance for purposes of reporting for 2025. So we'll see what sort of guidance comes out and whether or not, in fact, employers are required to separately account for qualified tips and qualified overtime.
Thank you. And I give so much credit where credit is due to my panelists here for going through 900 pages. Unfortunately, we haven't implanted Chat GPT and made them fully encyclopedic yet. So there might be one or two things that we don't get to or we're not sure about. We're never afraid to say, I don't know. If you have questions that we don't get to today and you would like us to try and answer them, within reason, just ping me with an email and I'll see what I can do. I know as part of the registration, I put a question, like if you want us to follow up with you, we're happy to do that. So I don't want to make this promotional, but at the same time, I don't want to leave I don't want to leave questions unanswered if we can potentially get to them. So, Liz, we're talking about retroactivity or not, but going forward to 2026, payroll systems probably going to need to be updated at least by 2026, not in 2026, but before 2026 to handle these changes.
Yeah, so a lot of these things are going to be expected to have been implemented by January 1, 2026. So it's the end of July. There's not a lot of time, but there's enough time for the IRS to feel like, hey, you've had the time to be able to make changes, at least for a substantial portion of it, right? So the expectation is that you have, that you take this time for the rest of 2024 and kind of audit your systems, make sure your HRIS systems are updated with the the tracking mechanisms to be able to make those reportings or make those changes and adaptions starting January 1, 2026. So this is, I would say, those things don't happen overnight. So definitely want to start soon on that. Some of the biggest aspects are going to be the tips and overtime. It's a big lift for a temporary measure, but hopefully somebody will come in and extend that. You never know how that will end up. But for right now, we just have to kind of look at the immediate future and say this is going to need to be updated and we're going to need to start tracking these a lot differently. We're going to have to adjust for the taxable fringe benefits that were previously not taxable that are now taxable. So there's going to be some reporting and adjustments there. Some of the expanded credits that employers are available to employers under the family medical leave stuff that will have to be incorporated as well. So there's quite a few places that, the difference between an HSA, what's going to be eligible for HSA versus FSA. I think there's quite a few places that you really are going to have to dig down and say, hey, does our HRIS system currently allow us to make these changes easily, or is this going to have to kind of be an overhaul?
And in addition to that, if you are concerned about what changes are in effect right now for the health savings accounts, the HSAs, there are choices that employers have to make. And if you on the call are in the human resource area of your company, what you can do is look to your outside brokers and representatives, because the changes that would be allowed for health savings accounts, for example, now individuals can pay for their telehealth expenses before they've even met their deductible inside their high deductible, high premium plan. And that used to not be the case. And telehealth, as you know, was something that was put in, it's been there, but it really emphasized during the COVID years when people couldn't get to their doctors or their caregivers. So look to your outside brokers, because they're rushing to change what they have in their documents to give you for open enrollment, because they will talk about the health savings accounts changes, and they will talk about the flexible spending account increases and the dependent care increases. So there's not much you have to do there. You just have to make sure your broker and your insurance people, all your outside consultants who help you with open enrollment, have these changes available inside of their documents. So think about how you don't have to do that much, but stay on top of your broker to make sure that their documents are reading right.
I think probably just to kind of add on to that, I see in the chat somebody had said something about we don't have any, how are we supposed to track the first half of 2025? Again, I think we're waiting on guidance to understand what the IRS says for that. So there's going to be a lot of manual calculations that are happening, I think, right now. You're going to have to kind of manually track this until we have a better understanding. But going back retroactively to the beginning of the year, I think we just need to, I hate to say this, I think it's a wait and see game, right? What is the IRS, what kind of guidance do they give, and what is the expectation? Because, from a practical perspective, they have to be practical with what the HR teams are already always underwater, right? You're always busy. So to have them have to go back and start tracking retroactively to the beginning of the year and try to decipher those things, I think is not super practical, but hopefully the IRS understands that. But that's something that we need to just kind of wait and see what the IRS says with that.
And I'd
Folks,
like
I've
to,
been waiting 3 years from the state of New Jersey to give us guidance on how to perform a workplace drug test. So hopefully the IRS is a little faster than that.
Well, don't hold your breath, but you never know.
Yeah.
so I'd like to address two questions in the chat. I am not sure if the tracking of 2025 amounts pertained to the HSA, but there are many individuals who would have paid for their telehealth with outside dollars, meaning dollars outside of the HSA. And so individuals have actually or should have tracked or would have receipts for anything that they paid, and they might want to be reimbursed with their pre-tax dollars from the HSA. That is a feature that the employer can do and can implement right now because it's already in effect, and let those individuals, maybe they paid $3,000 for telehealth even before they met their deductible. Well, now those amounts can come from their HSA. So rather than having paid $3,000 with after-tax dollars, they can have their HSA reimbursed. But this is something that the employer has to coordinate with their outside third-party administrator with respect to the HSA. And then with Judith Baker, her question about was this with respect to health reimbursement accounts, HRAs versus HSAs. I see it, I read it as this is in effect for the HSA, meaning that telehealth amounts can now be paid with HSA dollars before the deductible is hit inside of the plan.
Before I go back to Jewel for a little bit of lawyerly doom and gloom, which is, we're lawyers. We have to dispense that. We're halfway through. 450 pages down, 450. No, we're skipping around a little bit, but just want to reset. I'm Eric. That's Jewel. There's Liz down there, along with Greg. We're all from Pierson Ferdinand. We're hoping you're enjoying yourselves as much as you can going through tax and employee benefits and HR guidance on a 1 hour Zoom, but we think it's, time's flying. We're having fun. Uh, let's keep rolling. Jewel, I promise doom and gloom. What's the real risk if employers fail to update their reporting or plan documents?
Well, again, most of these decisions for the health spending arrangement will be posited to the employer by way of their outside broker. The risk is employees might be bothered they don't get some of the perks that the rules allow. And then with respect to the 5250 now made permanent and indexed in the future for educate payment of loans as a way to give employees money without being income taxed or payroll taxed on it. That's a feature that is at the option of the employer. The employer doesn't have to do it. It would be nice and a competitive offering of the employer to do it. If the employer wants that, then they need a plan document. As with most employee benefit perks, there's typically a plan document that outlines who can benefit and the change, what does it take to get the benefit, and so on. So without that plan document, certain of these features, including the Trump account amounts that an employer might give to an employee's child, can't be had. You need a written plan document to allow that perk to exist. And typically the perk can't be discriminatory in favor of, for example, the owners of the company or the highly compensated employees of the company.
Thank you. So, Liz, earlier I took note you referred to the family medical leave stuff.
Yeah.
This audience can resonate with that, along with intermittent leave. Now we have tax stuff to deal with, and it's giving all of us migraines, ironically. So, if you could, in broad brushstrokes, how does the expanded paid family leave credit work, and what should employers avoid?
Well, first I want to say I started my career in HR management. So every time that I go to try to say PFML, like it's an effort, because I just want to say FMLA, like, why do we have to change these things? It's tough for me. Like, I don't, just stick with the same nomenclature and it'll be fine.
All good.
But regardless, um, on a high level, it's Section 45S credit it's now permanent under this new act, and it provides a tax credit from 12.5% up to 25% on wages or PFML insurance premiums that are paid during qualified leave. So up to 12 weeks per year. The qualifying employees now only have to have had at least 6 months tenure, whereas before I think it was 1 year. Now it's down to 6 months, but they have to have at least 6 months. They must have worked there for at least 6 months. And you have to pay at least 50% of the normal wages. So employers will also have to have, as Jewell mentioned in her last statement, you have to have a written non-discriminatory policy in place. So the highly compensated employees cannot have a different plan. Like, everybody gets the same plan, and it has to be a written policy that you have in place. To calculate the credit, it starts at 12.5%. It goes up to, it's 12.5% on 50% of wages. So wage replacement up to 50%, you start at 12.5%. It increases by a quarter of a percentage point per point that you go up. So if you pay 51% of the wages, then it's 12.75% in credit. It maxes out at 25% of tax for the tax credit purposes, and that goes up to 80% of wage reimbursement. And then you'll just, the way that you claim it will just be to fill out the form 8994 and attach it to the tax returns. And this can be used to kind of offset those general business expenses.
Jewell, did I skip over Trump accounts?
Oh, no, you didn't. We covered.
Okay. I was hoping I didn't skip over Trump accounts. I saw we had a lot of questions in there, and I know people were asking about Trump accounts, how they work as a benefit, and the non-discrimination plan doc requirements. I think Liz just effectively covered that too.
Yeah,
No
I
more
think,
Go ahead, Liz. Yeah.
sorry, one of the pitfalls is going to be that if you have to update those policies and make sure that they align with the current law, right? So all of your policies are going to have to be reviewed at least and then updated. And it's going to be really important to kind of track all of I think everybody on this call probably knows that you already have to track leave pretty meticulously, but it's going to be even more important for the purposes of these credits, and an IRS audit will require proof of policy adoption and also and the payments, and also that all of that tracking documentation. So you just kind of want to be prepared in the event of an audit.
All right. So for ACA pre-verification changes, Liz, will they reduce employer penalties or just create more confusion?
Well, I think it's a little bit of both, potentially a little bit of both, right? Anytime you change a complex law, it's going to cause confusion. But it will also potentially reduce some of the penalties. So by decreasing improper subsidy awards, it could, the employer's portion of that would be subject to less clawbacks. Sorry. So so if it's going to be more difficult to get the subsidy, and the employer's shared responsibility for any clawbacks, I guess, would be reduced in that situation. So there's a potential for reducing employer penalties or their portion of a penalty by simply reducing the number of subsidies that people are eligible for. But again, I think there's going to be stricter enrollment. I think employees are going to come to you with a lot of administrative questions and requests. It's going to potentially increase the HR workload because they aren't going to understand all of these changes, and you're going to have to kind of hold their hand through it a little bit more. So it may be more administratively burdensome for the HR departments.
Liz, I'm seeing a question in the chat. Is there a white paper, info, or doc you have on the PFML changes? I'm looking at it right now, a paragraph in our white paper, the one that Greg and Liz prepared on PFML. I don't know if it gets as far into the weeds as the I lost it as Shannon needs. She posted the question, but I'm posting a link to it just so you can take a look. All right.
And I think, obviously there's a lot of lawyers out there, employment lawyers out there that are posting white papers on that specifically as well. So if we're not the only ones, we're not the only game in town, but if you have additional questions or if you want more specific information, we can obviously put something together for you. I don't think it would be, we can expand on our white paper, I guess, if needed.
Yeah. All right, folks. This is where I get to ask a question of myself. I feel like at times no, I haven't drifted into Harry Shearer in Wayne's World going, uh-huh, uh-huh, uh-huh. Like I'm listening. I am engaging, but here I realize on my script I get to ask a question of myself. And so I assume some of you folks may be wondering what these new tip and OT rules trigger. Will they trigger more wage and hour litigation? We've been talking about employee benefits, we've been talking about tax implications, but could no tax on tips result in more wage and hour litigation? And I think the answer is it's not that the one big beautiful bill suddenly gives employees new rights under the Fair Labor Standards Act, but by forcing employers to report total tips and qualified overtime premiums on W-2s, it creates a brand new paper trail. And that paper trail could be useful and show up in discovery in pending litigation. So, yes, in the short term, it's discovery ammunition. If you're already facing a wage and hour claim, plaintiff's counsel is going to ask for W-2s and compare them to your payroll and timekeeping records, especially for dealing with overtime claims. If there are inconsistencies, say overtime premiums weren't calculated correctly or tips were underreported, it becomes fertile ground for expanding the claim. Longer term, I do think we'll see more targeted litigation, especially in industries like hospitality, as we talked about a lot today. Greg talked about that, or healthcare. And once these W-2 reporting fields are in the system, they'll be tracked. There might be FOIA requests, subpoenas, you name it, and that transparency raises the stakes for compliance. So even though this is framed as a tax rule, it's going to have ripple effects in employment litigation. All right, got about 17 minutes left. Everyone's pretty much hanging in there. Thank you, folks. This is where we're gonna take some more questions from the audience, but while you're getting in those last minute questions, I want to ask our panelists. I'm gonna go around the wheel. I'll start with Jewell. What should employers be doing now to get ready for 2026?
Um, I just dropped it into the chat because I didn't
Oh,
have time to discuss this, but
sorry.
there are aspects to the law that explain that allow an employer to give extra perks to their employees. Yes, there's a cost in that the employer will expend money, but the fact that there is not income tax to the individual or payroll taxes on the part of the individual and employer are nice perks to consider. So that's how I sum it up, and it's in the chat.
Well, thank you. Liz, what do you think?
Yeah, I think an important thing is going to be check your policies, make sure you're getting those updated before that January 1 deadline, and then updating your HRIS systems and making sure that you understand any guidance that hopefully we have by that point. As we go along, just checking IRS guidance as it comes along, talking to your employment lawyers and to your HR team to make sure that the policies are correct and mirror what the requirements of the bill are or of the act are, and just making sure that your system upgrades are ready to go so that you're not backpedaling or trying to put more work on the HR departments to manually handle these things after the beginning of the year.
I'm gonna float a question to the group. We'll come back to that question because I want to ask Greg for his preparation tips for 2026. But the question I want to float, and this Nadia posted it. She would like a little bit more information on HSA and telehealth changes compared to before. So if someone's equipped to answer that, but in the meantime, Greg, what should employers be doing now to prepare for 2026?
Well, preparing for 2025 is even more urgent. And I think an open dialogue with payroll processors and continuing to be very diligent about trying to keep abreast of any developments that come from the IRS, which again, I would expect to happen before the end of the year, hopefully sooner rather than later, but definitely before the end of the year.
All right. Does anyone want to tackle the HSA and telehealth?
Yeah, I'll take it. So in prior years, HSA dollars couldn't be used for telehealth costs, which can add up if you're speaking to like a therapist or doctors or nurses, etc., and you paid for it with out-of-pocket dollars, after-tax dollars. You couldn't hit up your HSA account to pay that, and now you don't have to have met the deductible inside of your high deductible, high premium plan before you can use those HSA dollars. So if you expended thousands of dollars this year out of your own pocket, ask your employer to allow this feature in your plan so that you can reimburse yourself with after tax, excuse me, the before tax dollars in your HSA. And that is what was allowed for telehealth, and then for what's called direct primary care. That's usually like concierge services where you pay $100 a month to have a certain doctor or medical practice available to you, and you paid that out of pocket, and now you can reimburse up to a certain limit what you have paid for that concierge type service with HSA dollars.
All right. A few other questions I'm seeing before we each offer a key takeaway. Gina asks, are the student loan repayment only for those that are used during the time you are with your current employer, or can they be applied with student loans from 20 years ago?
Yeah, that is a great question. As long as it's a student loan for higher education, it can be from 20 years ago. There just needs to be evidence that's being paid to a student loan or a financial institution, not your next door neighbor, for example. So the loan did not have to be incurred while employed with the employer who's handing you that 5250 every year. And the reason I underscore that this is a great perk, it really is a way for an employer to say, we care about you. We know you're spending a lot of money paying off your student loan. So we're going to give you 5250, or we might match, meaning you pay your student loan, and when you pay $5,000 in your student loan, it's as if you're putting $5,000 in your 401k, and we'll give you the match that we would have given someone who put 5,000 into the 401k. So no, that loan doesn't have to be a loan made today or with this employer.
I'm sorry if I was just scanning the chat and I heard every 1.5 words you said, Jewel. Someone asked, is the telehealth provision only for HSAs, or is it also for high deductible health plans in general?
Uh, so, yeah, the high deductible health plan can pay on the telehealth as
Okay.
well.
Okay. Crystal asks, she's still interested to see if the PFML is required or optional. Do we know? Has she stumped the panel? It's okay.
Well, what's the question? Whether
Crystal
the
says,
credit option.
still interested to see if PFML is required or optional. Oh, and Stephanie, someone else responded in the chat, depends on the state. In Texas, it is optional. So this may be a state by state issue. Let's see. We got about 10 minutes left. We can handle another question or two. Let's see.
Well, while you're looking for a question, I kind of want to throw something out there.
Please do.
To Jewel's point from earlier or from just a few minutes ago. I think this is a really good opportunity, even though you don't necessarily have time to do it, but it's an opportunity for your HR departments to come up with, to kind of revise and take a new look at their HR strategy and say, hey, how are we retaining talent? And, what are some things that we want to do given these new incentives? And, I think it's hard to take a look with fresh eyes at an HR strategy once you've already developed it, but modifying it as we go is always helpful. So it's an opportunity. It kind of pushes you down that path a little bit, but it is a great opportunity to kind of look at your retention, look at what your incentives are and kind of revise that, look at your employee handbook and say, hey, does this look like it accounts for all of the things that we are now offering our employees, making sure that things are up to date and that you're targeting your talent pool the way that you want to be. So it's still a good opportunity, even though it's kind of forcing your hand.
Great. Chris and Toner says, Eric Meyer, we need more of these because your tax team is great. I concur.
Oh, thank you.
We'll see. We'll see how much bandwidth we have. But if you want more of these sessions, throw it in the chat. Let me know. We'll see what we can do. Here's a question I can answer. Lisa asks, for overtime, is it FLSA I think there might be a typo here. For overtime under the FLSA, is it over 40 hours a week and will not, or does it apply to daily overtime? It's hours in a work week. So for Fair Labor Standards Act purposes, paying when to pay employees overtime, at least at a federal level, Fair Labor Standards Act, you look at the number of hours worked in a work week. If the employee is non-exempt and they work more than 40, they get time and a half, generally speaking, on those hours worked over 40. Now, your mileage may vary state to state. So some of those states where I'm not licensed to practice, I'm guessing California, if I had to hazard a guess, but I don't want to commit to it, might have different rules for hours worked over 8, for example, in a single day. Maybe New York, I don't know. I'm not licensed to practice there either. We got about 7 minutes left. How about we go around the wheel and do one key takeaway for the audience? Greg, you want to start? We'll start with you.
Sure. I think, studying the law, studying what comes out, there's plenty of information on the web that goes through a lot of these provisions, some in more detail than others. But there's actually a lot of opportunity for learning and becoming familiar with these provisions and staying abreast of developments.
Awesome. Liz, key takeaway. What do you think?
I think the key takeaway here is that this, although it's burdensome and difficult, and there's going to be a lot of work to do for the HR departments, I think it's also an opportunity to claim really valuable credits. And then also, again, like I said, look at your employee satisfaction rates and your retention rates, and it gives you an opportunity to get those credits, but also review the way you're operating now and what you're doing from an HR perspective.
Jewell, key takeaway.
I reiterate what Liz said, that what a great opportunity for your human resource and compensation committee to take a look at what perks you're giving to employees, and could this current law help you in terms of better perks, enhanced perks, or public relations.
Awesome. Yep. Here's my key takeaway, because I'm learning as much about this as I think a lot of our audience is today, is lean on the professionals. If you have questions, this is a 900-page bill and you're not expected to handle it all yourselves, of course. Lean on your brokers, lean on your tax professionals, lean on your in-house counsel, your outside counsel. This is something where you don't want to slip up. So please, get help. Obviously, we're here today giving non-legal advice, and we're here today to put it out there, to help people if they want it. But if you have existing relationships, leverage them and get the help you need. We have 5 minutes left. I want to give everyone a chance. I want to thank my panelists, give them a chance to promote themselves and let everyone know what's going on in their lives. And then if we end a minute or two early, hey, no one ever got mad when a Zoom meeting ended 2 minutes early for a scheduled hour. So we'll go back around the other way. Jewel, tell everyone what you got going on in your life and how folks can reach out to you.
You can reach me by going through your contact, Eric Meyer. He knows how to get me. I do spend all my time in the employee benefit slash exec comp slash, tax space. But when I'm not doing that, I'm diving, and that's the reason for my screen background there, that I'm a scuba diver and I love it. Bye and thank you.
And Liz is scouting out the Northern Lights, but when you're not doing that, what else you got going on?
When I'm not trying to hang out, watching the Northern Lights, I focus in the corporate area, so I don't have a major focus on the employment side of it, but I certainly can help with the tax pieces of that. Tax lawyer, international, federal income tax, any of the corporate contracts, and trying to understand um, any structuring concerns that may come out of the other changes that are included in this bill. So obviously they can contact me through you as well. I think you can probably put them in touch with all of us.
And you can connect with three-quarters of us on LinkedIn. The one quarter, Greg, tell everyone what you've got going on in your life.
So I spend most of my time doing M&A tax work, but I do periodically have one-off questions that I enjoy fielding. Um, Again, there's always a lot to be learned, and you can never be too smart when it comes to tax law. So spending a lot of time these days trying to understand and read the latest.
Awesome. Well, thank you again to my wonderful partners for lending us not just an hour of their time, but all the prep, the white paper. It really is. This audience appreciates it. Thank you so much to the audience for showing up today. We broke records on registration. We had well over 500 of you for a while. I will post a YouTube link in the blog post. I'll put it on LinkedIn. I'll share it every which way I can. Subscribe to the YouTube channel. Just Google the Employer Handbook YouTube channel. Subscribe. That way, click the bell icon. That way, you'll be alerted when it gets uploaded so you can see this. I'm already getting emails from people who couldn't make it. Yes, it's going to be on YouTube, I promise. All right, folks. Well, thank you very much for coming out today. First week of NFL preseason, NFL training camp. We're back, defending champion Eagles. I love it. Saw the Giants first pass was a touchdown pass, just happened to be a pick six. All right, I'm getting off on a bad tangent. Anyway, thank you,
Right.
and hope everyone enjoys the rest of the week and has a great weekend. Bye now.
Thank you.
Thank you, Eric.
Bye bye.